My name is David Buckland and I'm Chief Executive of Montgomery Investment Management. The record low cash rate in Australia of 2.5% seems to have put a spark under the housing market. At Montgomery, we remain more than a little wary. We're mindful that Australians' household debt to disposable income ratio has exceeded 130% for the past 4 years, and there doesn't look to be any signs of improvement soon. For context, this household debt to disposable income ratio was 50% 20 years ago and only 25% 30 years ago. Australians love debt, and debt is great when the underlying value and the underlying cash flow of the assets acquired are going up. The problem is there are shocks. These shocks may come in three forms. The first shock is rising unemployment. We're worried about rising unemployment as manufacturing in Australia continues to come under pressure. The second shock may be rising interest rates. While this is not our central case, we note that longer-term interest rates are trending up all over the Western world and have been for the past 18 months. The third shock is the declining value or cash flow of the acquired assets. Again, this is not our central case, but viewers should be aware this does happen. This leads me to a comment on Christmas retail sales. Despite a lot of excitement, a number of retailers are reporting very sober numbers. Take, for example, Supercheap Auto, which announced a 20% downgrade to its expectations for the 6 months to December. It appears the slowdown in the mining and resource sector has negatively impacted their leisure division. Supercheap fell from $12.50 to $10.50 in response. A second example is The Reject Shop, a seller of discount variety goods, which also added to the negative news with a 30% miss relative to analysts' expectations. The share price accordingly declined by 32% from $16.90 to $11.50. The CFS Retail Property Trust showed in their market update that department store growth for calendar 13 was negative. This puts a cloud over the outlook for the businesses such as David Jones and Myer. Finally, the 16% decline in the Aussie dollar from US 140, US 88 in the past 12 months will likely see imported goods, including those Samsung flat screen TVs from Korea, jump in Australian dollars. So despite the record low cash rates, we believe the household debt to disposable income ratio remains a brake on growth of our domestic economy. Because of this, more negative surprises from the upcoming reporting season is a possibility. That's all from me this week. Please follow us on Facebook and Twitter.